Okay, so picture this. You're at the checkout counter, and the guy behind the register asks, "Would you like to add the protection plan for $4 a month?" And somewhere deep in your brain, a little voice says yes, just in case. You say yes. You always say yes. And here's the thing, that just in case voice has probably cost you thousands of dollars over your lifetime, and nobody ever sits you down and does the math on it. So today, we're doing the math. 10 things that used to make sense, or that you were told made sense, that honestly just don't anymore. And by the end of this, I guarantee at least 3 of these are things you're currently paying for right now, today, without even thinking about it. Let's start with the one that got me the most. Extended warranties. You buy a car, a laptop, a washing machine, and someone offers you extra protection on top of the manufacturer's warranty. Feels responsible, right? Here's the actual data. Roughly half of vehicle owners who buy an extended warranty never end up using it. Not once. And the people who do use it, a well-known Consumer Reports survey found the average buyer pays around $1,200 for the warranty and gets back less than $900 in actual repairs. So you're not protecting yourself. You're just prepaying a company to bet against your own car breaking, and the company almost always wins because they built the pricing model, not you. Number 2, and look, I know this one's going to upset some people. Buying a brand new car off the lot. The second you drive it away, it starts losing value, like immediately. Most new vehicles drop somewhere between 8 and 12% in value the moment they're titled in your name. Give it a year, and you're down 20% or more. 2 years, closer to 30. By year 5, that car is worth roughly half, sometimes less, than what you paid. Think about that. You are voluntarily setting fire to the value of a giant purchase just so you can smell the new car smell for 6 months. If status and smell aren't the priority, buying a 2 or 3-year-old car lets someone else eat that depreciation cliff for you. Number 3, cable TV bundles. This one's almost embarrassing at this point. People are still paying $80, $100, $120 a month for hundreds of channels they don't watch, plus box rental fees, plus regional sports fees they didn't ask for, to watch maybe 6 shows. Streaming isn't even cheap anymore, I'll give you that. Prices have crept up. But even if you stacked 3 or 4 premium streaming services together, you're still usually paying less than half of what the cable bundle costs, and you're only paying for content you actually watch. Number 4, and this one's more about psychology than money. Gym memberships you're not using. Look, I'm not telling you to cancel the gym. I'm telling you to be honest about whether you're a person who goes 4 times a week or a person who paid for the identity of being someone who goes 4 times a week. Gyms count on this. Their entire business model depends on a huge percentage of members paying every month and rarely showing up. Because if everyone who signed up actually came in, there wouldn't be room. If you haven't gone in 2 months, that's not a gym membership anymore. That's a subscription to guilt. Number 5, whole life insurance, when what you actually need is term. Here's the frustrating part about this one. Whole life gets sold with this whole pitch about it being an investment, about cash value, about lifelong coverage. And technically, sure, some of that is true. But for the vast majority of people, especially younger families just trying to protect their income, whole life premiums can run 5 to 15 times higher than a term policy with the same death benefit. That difference, if you actually invested it instead, tends to build far more real wealth over time than the cash value the insurance company is crediting you. Whole life isn't a scam, but it is very often the expensive answer to a question most people didn't need to ask yet. Number 6, timeshares. I almost don't need to explain this one, but let's do it anyway because people still fall for the pitch every single year. You sit through a 90-minute presentation, they offer you a free breakfast, and you walk out having agreed to pay annual maintenance fees that increase every year on a property you can barely resell because the resale market for timeshares is famously brutal. People have listed timeshares for a single dollar just to escape the yearly fees and still couldn't find a buyer. If a company has to bribe you with breakfast to hear the pitch, that should tell you something about how the math works out for you afterward. Number 7. Lottery tickets. Bought regularly. Framed as a strategy. Occasionally, for fun. Sure, that's entertainment. That's fine. But there's a specific pattern where people in tighter financial situations spend a real chunk of their monthly budget on tickets, essentially treating it like a retirement plan. The odds on the big jackpots are somewhere in the range of 1 in 300 million. You are dramatically more likely to be struck by lightning, more than once, than to hit that number. The lottery isn't a wealth strategy. It's a tax on hope, and the state knows it. Number 8. Bottled water as a daily habit. This is a small one individually, but stick with me. A single bottle at a convenience store or vending machine can run you $2–3. Do that once a day, every day, and you're looking at somewhere between $700 and $1,000 a year for something that comes out of your tap for fractions of a cent. A decent reusable bottle pays for itself in about a week. This one's less about the money and more about how easily we let small, invisible habits quietly drain thousands of dollars a year without ever noticing. Number 9. Bank overdraft and maintenance fees. This one makes me genuinely frustrated because it disproportionately hits people who are already struggling. The average overdraft fee sits around $35, and banks have historically pulled in billions of dollars a year just from these fees alone. That's not a service charge. That's a penalty for being a few dollars short, charged by an institution that's already holding your money. At this point, there are enough fee-free digital banks and credit unions out there that paying overdraft fees is almost always a sign you haven't switched banks yet, not a sign that you did something wrong. And number 10, the one that ties all of this together. Letting large amounts of cash just sit in a traditional savings account, earning basically nothing. This isn't a scam like the others. Nobody's tricking you, which is honestly what makes it worse. Big traditional banks have paid savers next to nothing in interest for years, sometimes a fraction of a percent, while inflation quietly eats away at the actual purchasing power of that money every single year. You could genuinely have money safely saved and still be getting poorer in real terms without ever touching a dollar of it. So here's the actual thread connecting all 10 of these. None of them are a single catastrophic decision. Nobody goes broke from one extended warranty or one lottery ticket. It's death by 1,000 small, just-in-cases. Small why-nots. Small decisions that each felt completely reasonable in the moment. And the fix isn't complicated. It's just uncomfortable. Go look at your bank statement from the last 3 months. Actually look at it. And ask yourself honestly, which of these 10 you're quietly funding right now? Pick one. Just one. Cancel it, switch it, or fix it this week. You don't need to overhaul your entire financial life today. You just need to stop the bleeding in one place and let that money start working for you instead of against you. That's it. That's the whole video. Now go check your statement. And if this one helped, hit subscribe, because next week we're breaking down the one safe financial habit that's quietly costing people more than all 10 of these combined.